Imagine starting from scratch in 2025. No portfolio, just cash. What would I buy first? I would buy these 3 stocks, and I'll even show you the price I'd pay for each. Most people are asking constantly, what would you buy right now? But that question becomes way more interesting when you imagine starting completely over. No positions, no baggage, just a blank slate and the opportunity to do it right from day one. In this video, I'm going to walk you through the 3 stocks that I would buy today to rebuild or start my portfolio. These aren't just hype names or guesses. They're on my personal list of 33 stocks I plan to hold forever. I already currently own half of them, but if I could only pick 3 to start with today, these are the ones, and I'm going to walk you through why, how I analyze them, and the exact price that I would be comfortable paying for each one. Now, guys, the full list of 33 is right here on the screen. I'm not going to go through every single one of them, but my philosophy in investing, based on my position in life and the fact that I have 1,000 apartments and I have several businesses running, I am focused on companies that I think will be around for years and years to come, for decades to come. Now, that won't maximize our returns. And the reason being is it's harder to make outsized returns on larger companies. But these are companies that if I pay the right price for them, I can still get better returns in the market if I'm able to stay emotionally in tune and sit there and buy when there's fear in the streets. Now, instead of going through all 33 of these stocks, I made a PDF for you. If you want to see all 33 stocks, why I'd own them, etc., click the link below. And within 1 minute, you will get an absolutely free PDF with all 33 of these stocks and why I like them and why I'm buying them. Now, this is exactly why I like value investing. It allows me to sit here and say, I love all of these, but I'm going to wait. I'm going to be patient. I'm going to wait for the right price. And some people might think, well, what if the right price never happens? Guys, the right price always happens. There will always be a point when the stock makes a lot of sense. It's impossible to not be that way. I've been investing since the mid to late 90s, and I've never seen one stock ever dominate and be overvalued forever. It does not happen. Now, whether you're new to investing or more advanced, think about companies and stocks as the same thing. Right now, a lot of people out there will sit there and say, well, a stock is a ticker that goes up and down. No, you're buying a piece of a business. And that first business is Alibaba. Guys, this stock, this company is a company that has been through hell for the last few years. It hit a high of over 300 years ago and got as low as $50-some in the last 2 years. And the story has changed time and time again about Alibaba. It was first the most amazing company, better than Amazon, was about part of China. Then the stock started to slip. So what happened in the news? The news follows the stock price. And as the stock price fell, the news came out to justify that price falling. Every negative story about the company that came out existed as it was marching its way over $300 per share. The difference is people ignore it when the stock is going up. When it's going down, it's the excuse as to why the company sucks. Some of these issues were ADRs, which means any company that's overseas like Alibaba, you don't actually own the business when you own the stock, unlike Microsoft. The China and Taiwan issues, and just issues in China in general. These are all things that people brought up as this is why the company sucks, to which I always said, yeah, but when the stock was at 300, that was also true. So these are the things I want you to remember no matter where you are in the spectrum of investing. Now, this is a company that right now has a $293 billion market cap. It pays a little dividend here, $4 billion a year, about 0.84. This is something new. I'm not a huge fan of that. Why? Because I think the company is on the cheaper side of things, and they can use that cash flow to buy back shares, which, by the way, Alibaba is doing that. They have announced major share repurchases. Now, in our community, we have a buy, sell, hold rating system. And right now, 34 of our community members have rated an average of buy for Alibaba. But it ranges from sell to strong buy, a wide gamut. And again, guys, if you're in our community, do me a favor, go into the software and give your opinion on all 3 of these stocks we're going to talk about. Now, Alibaba is in the fastest growing middle class in the world. China has amazing growth potential. Yes, they are still communist and they're still getting out of that. But let me give you a little secret that I tell everyone about communism. Communists love money. They love money and they want to make as much as possible. And you know what they become at the end of the day? They become capitalists. And China is still a very capitalist country that's getting even more so. And the average person in China is making a lot more money. As that happens, they're going to go to Alibaba. And Alibaba is also creating its own cloud computing business that is growing handsomely over time. Guys, look at their profit margin. In the last 5 years, the average was 11%. Last year, 13%. Their gross margin is 40%. Well, what's gross margin? Gross margin is the profit they make on every single unit they sell. Every extra dollar they bring in, 40% of it will go to the bottom line before overhead and taxes. The other thing, growth rate in revenue. It's down quite a bit, 30% a year for the last 10 years, 14% a year for the last 5, and 5% for the last 3. But I also think that China's experiencing a little bit of a slowdown. Recessions are going to happen, and even a Chinese recession still involves growth. The question I have to ask you is, do you think China will be more capitalistic 20 or 30 years from now or less capitalistic? If more, what does that mean for Alibaba? I think that means a lot of great things for Alibaba. I'm looking at this from that perspective. Now, if this is overwhelming, you're not alone. I'm here to simplify all of this. And one of the most important things is, in a couple of minutes, I'm going to walk you through the price I'd pay for the stock. But first, let's get to our very famous 8 pillars. Now, the 8 pillars, 5 checks, 3 X's. Those 3 X's, net income is down for some odd reason, even though the 5-year net income is significantly lower than last year's net income. Free cash flow is down, which is explained right here. The last 12 months of free cash flow was $6.7 billion versus the last 5-year average of 18. Now, here's what I love, guys. Their 5-year average free cash flow is $18 billion. Their 5-year average net income, $13.85. I think this is a random fluke year on cash flow. And if you look at their financials, more specifically on their cash flow, I'll show you what I mean by that. So we're going to go to the cash flow statement. And if you look right here, they had a big jump in capital expenditures. Big jump from $4.5 billion to $12 billion. Does that sound like anybody? Didn't we talk about that with Amazon for years? They kept investing back in themselves. So let's see what analysts think about this company. Look at this. $9.34 per share in profit here, growing to $13.58. 5%, 13%, 13%, 13%. That is some pretty solid growth for a company that everybody's worried about. Again, nothing is set in stone. This has changed a lot. It was flat for a long time by analysts, and now they've upgraded it. And the revenue growth, 6%, 7%, 8%, even 8%. So again, some growth, not a ton, but if they're able to grow their earnings per share, buy back those shares at cheap prices, they're going to really increase that earnings per share and really skyrocket the price of the business. So now, what's the right price to pay? This is why we use Stock Analyzer tool. This tool was created to allow us to put the story and the numbers together. When you put these together, it gives you an appropriate price to pay. But guys, we don't know the future, and we're humans, we make mistakes. That's why we have a low, middle, and high assumptions for all the companies we do here. I use a 10-year analysis, so you can go up to 20 years on this software. But the point of all this is to say, let's put it all together to say, what's the right price to pay for this company? And it's going to differ for everyone. Mo and I, when we do these companies together, we have different numbers involved. We never get the same number. Warren Buffett and Charlie Munger, they used to talk about Berkshire Hathaway. They'd say, if you asked Warren and I to give a value for Berkshire Hathaway, we'd come up with different numbers. That's the beauty of investing. That's the art of investing. So the last time I did Alibaba, here are my assumptions that I made. I did 3, 6, and 9% revenue growth in the next 10 years. I did 12, 15, and 8% profit margin. I did 15, 18, and 21 on free cash flow. If you notice here, in the last 5 and 10 years, free cash flow was larger than the profit margin by a large amount. So I'm going to focus on the free cash flow number here. Over a long period of time, for those of you who are new to investing, free cash flow and profit should equate out over a long period of time. In the short run, they can differ wildly. But the key is if they do differ, and profit margin's higher than free cash flow, you need to understand why, which I showed you in the cash flow statement about profit margin. The cash flow was a lot lower because they had a lot more capital expenditures. They spent more on their fixed assets and making the business better. Now, what is the PE and price of free cash flow that I would assign to this company in 10 years? Well, I picked 15, 17, and 19. And then what return do I want? Now, guys, I put 9% in here. Basically my way of saying, what do I think the company is worth? This 9% has no margin of safety. It's just, what do I think the company's worth based on the market? Now keep in mind, I don't think anybody should buy a company based on what it's worth in the market. If you're going to do that, just buy a low-cost ETF and go on with it. If you want to have a margin of safety, you need a higher number than 9%. What's that number? Guys, it all depends. How well do you know China? How well do you know Alibaba? How comfortable are you with it? The less comfortable you are, the higher margin of safety you need to have. The more comfortable you are, the less margin of safety you need to have. It's all personal. This is why, in our community, this thing is used over 1 million times per year. So, put all these things in, I hit the analyze button, and boom. Guys, I have a low price of 105 to 133, high price of about 300 to 340, and a middle price of 180 to 220. So this is why I would add this company to my portfolio to start out. It's got a lot of upside potential there. Now, guys, for me, for China, another country, I want 13, 14% of this company. And if you look right here, based on the current price, down below here, it tells you the return you would get based on each of your assumptions. So on the middle assumptions, based on buying at this current price, I would make a 17.5% return on my money. Is this for sure? No. But the key is, if I own 30 companies like this, some of them I'll be wrong on, but the ones that I'm right on and the ones that I'm underestimating are going to absolutely crush it. So my returns are going to be big. That's the key here. Company number 2, guys, is PayPal. Guys, PayPal for me is another company, was over $300 a share. Now it has plummeted, got as low as 50. And people are like, oh, everything's taken up. Guys, PayPal owns Venmo. PayPal is the trusted source for buying things internationally. If you want to trust something, if you want to have a company that has your back, it's PayPal. Guys, I believe in this company. That's why I like it. And as the stock plummeted, I paid attention. So some of the things to look at, $76 billion market cap. This is what I love. Free cash flow last year of $6 billion, last 5 years, $5.2 billion, way higher than the net income. That's what I love as well. We've got profit margin consistently about 14% with gross profit at 46%. And guys, look at these growth rates on revenue. Look at this. This is what I love. 14.5% over the last 10 years per year, 11.8% for the last 5, 7% for the last 3. In our community, we have 46 members who are voted for it, and they have the average rating of as a buy, with 2% saying sell, 26% saying strong buy. Now, keep in mind, these go back 6 months. In the last 6 months, prices could have changed wildly. Somebody could have gone in here when the stock was in the 50s and voted strong buy, and it's changed because of that. Now, guys, let's look at the 8 pillars here. This is an 8-pillar thriller, all 8 check marks. Now, I want everybody who's new to understand this. The 8 pillars are not a way of saying buy or sell. It's a way of saying, what's the story for this company? All the numbers are check marked green here. So the first question I would have if I'm an investor is, well, why is the stock down 75%? You have to ask those questions. There might be a very legitimate reason for that. Or it could be an opportunity where there's mispricing. And it seems to be from our users in our community that they think there's a mispricing here. But one thing I do love, guys, they're buying back cheap shares. I love it when a company buys back cheap shares. That is the best. But every metric here is growing. The only metric that they had for a while there that was declining was the number of users. You might sit there and say, Paul, that sucks. Yeah, it does. But the amount of revenue per user is absolutely climbing. And that's what's very important to understand. And Venmo is still a great source and a safe source for paying money. So let's see what the analysts say about this company. Guys, analysts have this company growing from $5.20 per share in earnings to $8.43, which is 11, 13.5, 10.5, and 16.5% earnings per share growth. That's a lot of money for a company that everybody said was dying. And for revenue, not huge, 3%, 6%, 7%, 7%, 5%. Not huge, but with 46% gross margin, it can add a lot of money to that bottom line. So finally, what is the right price to pay for the company? So let's pull up my last assumptions. I did 10-year analysis again. I did 3, 5, and 7% revenue growth. And just like Alibaba, their free cash flow is higher than their profit margin. So I focused on free cash flow. I did 16, 19, and 22%. What's my PE and price of free cash flow in 10 years? I did 14, 17, and 20. And again, my 9% desired return, no margin of safety. Now, believe it or not, guys, 20 some years ago, I was not doing this. I was not understanding what I was buying. I was chasing hot stocks. I was following tips. I was getting caught up in the hype, hoping that the story would lead me to the promised land. But now I've realized that's not investing. That's gambling. And the benefit you guys have is you have somebody can sit there and explain that. Because I'm sure everybody watching this at some point or currently has that same thought, like, it's a great story, it's going to work. This is why I created Everything Money. When I realized that these things did matter, I wanted to give people like the 25-year-old me the tools and the strategy and the community that I never had. So when you join EM, you're not just getting this powerful investing software and our world-famous stock analyzer. You're getting a foundation. We integrate you into the community by watching courses so that we all have the same foundation and get you engaged in our community of like-minded investors who are leveling up their investing game so that you can have the mindset and support along the way, along with the software and tools. And guys, even more exciting, we're about to add a brokerage to the platform. This is a spoiler alert. Several brokerages, and probably the brokerage you're using right now, will be integrated into our software. What that means is, as you're sitting there doing research, when you're ready to buy, you just click buy. When you're ready to sell, you click sell. And it's all done on the back end with your brokerage. We never hold any money. It's all coordinating our software with your brokerage, and all the major brokerages are supported. This is the next chapter of Everything Money, and we want serious investors to be part of it. But let me be clear. This is for serious investors. When I say serious investors, if you're new, you can still be a serious investor. I want people who are willing to learn. If you're the person who wants to chase the next shiny object, we're not for you. If you're not ready to find a process that you work with and stick with it, don't sign up. But if you're committed to learning and getting better, no matter where you are in the financial spectrum, whether you're a newbie or advanced, if you're ready to learn and get better, this is the right place for you. So start your 7-day trial today. Click the link below. We limit the number of spots every single day, and we don't know how long we're going to keep the trial open. Because another spoiler alert is we've talked about making this application only. So if you're serious, this is your moment. Go give it a shot. So back to PayPal. I have all these assumptions in. I hit the analyze button. And guys, I have a low price of 60 to 75, high price of 130 to 175, and a middle price of 90 to 116. For my middle return of 15%. Again, this company sold close to 50 at one point. This number here of 15% on these same assumptions was close to 20%. That's the beauty of having a tool like this. As the stock price changes, so do the potential returns, and you've got to be ready for that. Stock number 3, guys, Southwest Airlines. And the interesting part about the Southwest Airlines is my thesis is very, very simple. Southwest Airlines before COVID was making 10 to 15% like this. They were the best run airlines. They still are one of the best run airlines, if not the best. But they've had a few issues lately with their computer systems, and they've made a lot of changes because of pressure from shareholders, because the stock is basically at COVID levels still. Now, why do I like this? Guys, in the last 5 years, the profit margin's been negative 0.65. Last year was 2%. Before COVID, it was 10 to 15%. This is purely a reversion to the mean play. What I mean by that is the profit, I think, will get back to normal levels. This is a company that for 48 years in a row before COVID never lost money. It only lost money in the year of COVID. That's it, the year after. I look at this saying, most airlines go through several bankruptcies in the last 50 years. This company has only lost money one time. They stick to one plane, so they know it inside and out. They stick to profitable, direct regional routes, and they hedge their fuel beautifully. That's why I love this company. That's the pure play of it. Nothing else matters to me except for that exact point. Now, let's see if analysts agree with me. Analysts are taking this from $1.18 in earnings per share to $4.25 in the next 4 years. That's almost 4x, guys. 4x. Okay? At $4.25, and let's say it's worth 20 times earnings, that's a $95 stock in 4 years. Would you like to almost triple your money in that time? And revenue, record revenue, guys, and growing, $28.5 billion to almost $32 billion. It's an airline. It's going to grow with the economy. It's not going to grow gangbusters 10, 15, 20% like these tech companies. It's going to grow with the economy. Now, after we're done with Stock Analyzer, I want you to wait because I have a very specific takeaway I want you to hear about this. And it's very important you hear it. So, Southwest, I did 2%, 4%, and 6% revenue growth for the next 10 years. I did 8%, 11%, and 14% profit margin. Guys, my highest number, they've done higher than this highest number. That's what's incredible. PE, price of free cash flow, 14, 17, and 20, and 9% return. And now you guys will see why it's on my list. Now remember, for all the stocks, all three of these stocks, I own them, but don't go buy them because somebody on the internet has them. We're here to teach a process. That is the most important and most beautiful thing. Hit the analyze button. A low price of 52, high price of 152, middle price of 92 for a 23.5% potential return. And guys, the people in our community have this company rated as a hold, actually. A lot of people disagree with me on this one. I have it as a strong buy. The average community member has it as a hold here. That's incredible. I love seeing that. Now, you don't need 100 stocks. You need to find a few great ones bought at the right price. So what's really important for me is for you guys to understand what I mean by that. Earlier this year, I picked my own Magnificent Seven, 7 stocks to go head to head with the real Magnificent Seven, the Nvidia, Microsoft, Amazon, those great ones. And guess what? It's short. It's only been 6.5 months, but my stocks are winning by a lot. And I'm not just talking about theory. I put these stocks to the test. All 7 of these stocks I currently own. They're outperforming the market's biggest, most hyped names. So click on the video on your screen to see which 7 stocks are beating the Magnificent Seven and then why they could keep winning for years to come. It's really important to understand this to see that numbers and valuation beat story in the long run if you pay the right price. Thank you for your time.